This computer starting now. All right, guys, welcome. All right, so tonight, like I said, we're going to basically review the two previous courses, introduce a couple other concepts. So let's just hop right into it. All right, so previous two courses or the previous two classes, we got into institutional order flow. And what institutional order flow is, it's a different view or a different approach to supply and demand zones or support and resistance. It tells the reason why things happen. Okay. So what I said happens, or what we look for, is, let's say if we're looking in a buy situation, right, or buy model, we want to see price come down, find some type of support, right? Let me use something else. I use perfect lines. So basically, we want to see price come down, find some kind of support, shift away, and on this shift away from this bottom, we want to see that high or this move break this structure right here. Okay. So what happens is, we know that at this low, you have, let's see.
Sorry to interrupt you. Am I supposed to just be looking at it?
Hold on real quick.
Hello?
What happened?
Hey, am I supposed to, sorry to disturb you, man. Am I supposed to be just looking at a blank screen while you're drawing and just kind of going over what we expect the candlesticks to look like?
No, do you see the white screen with the red markup or no?
Yeah.
Yeah, that's what you're supposed to be seeing right now.
All right.
I'm gonna show you this on the chart too. All right. So price comes down. Here's your rally down. Your push down. Hits a floor or hits a support. Pulls back a little bit. And then on this push down, this next push down, or this final push down, we want to see price exhaustion, right? And now I remember saying price exhaustion was like candles with wicks. Okay. So we want to start seeing, pullbacks, something like this, towards the low, because that's letting you know price came down here, but retraced or pulled back, because that's exhausted. That's exhaustion. Price doesn't want to go any further than where it's at just yet. So this previous history point, previous structure point, told you once before, price pulled back. The second test, price shot the hell out of there. This is what we want to see. This change in momentum that breaks this previous structure point. Okay, because what happens is, depending on how long or how strong this is, on this pullback that happens, that's when we fib from low to high, and we end up getting the different ratios. And we like to have anywhere between the 61.8 all the way to, and no further than the 886. Pendings go at the 786. Okay. So now what happens is whenever there's a break of structure, guys, so this was a ceiling, this was a resistance, right? Whenever price broke through that, first thing it's going to do more times than not, or damn near all the time, is going to test that same price area or that same structure point to validate that as structure. So what that means is if you see the same situation that happened down here forming up here, which means you could see some consolidation happen, or you can see another move like that happened previously, like this, because it's going to find support. This ceiling is now activated as a support with the higher lows. So you've got the lowest low and then the higher low. So if you drew your trend line, guess what? You're following that trend line, right? And that's what we're looking for. Institutional order flow comes in. Come on, eraser. Why is it not erasing, G? There we go. All right. Institutional order flow comes in right here. Let me get a box for that. All right, so what we do is on the wicks of these candles up to the bodies, once I show you this on the chart, is we'll draw this shade box and drag it over to the future. Because again, this is more than a supply and demand zone. This is an institutional order flow zone. This is where the order blocks, which is I'm going to detail what's an order block here in a second. This is where smart money is buying against the trend. So on this down move, smart money's buying because they know price is going to break up. This down move, smart money's buying. Second entry shoots up. Third entry shoots up. All right. So like I said, what we do is we fib from low to high on the buy model and let the price retrace into the zones. Okay. And let's go through the charts real quick. No, let's go to the order blocks. All right. Okay. So this slideshow is basically going to touch more upon the institutional order flow and the order blocks themselves. Okay. So that way you all have an understanding of what exactly an order block is and what's happening inside the transaction itself. Some of the information may be repetitive, but again, this is, you need to know. Okay, so institutional order blocks are specific candles or bars that, when properly viewed in institutional context, can highlight smart money buying and selling areas. They are not a supply and demand zone. Those are broad ranges or zones, okay? Order blocks are specific candles or bars. Supply and demands, those are broad zones or ranges. That's the difference between the two. We're able to refine these order blocks all the way to the 5-minute and the 15-minute charts for pinpoint precise entries. but we'll begin looking for them on the weekly and the daily charts. All right. So, but what is an order block exactly? An order block is an order or trade submitted for the sale or purchase of a large quantity of securities. An order block trade involves a significantly large number of equities or bonds being traded at an arranged price between two parties. And this is on the institutional level. This has nothing to do with retail traders. These orders kick off the large trend moves or impulse legs of the market. All right. So once you're able to train your eye to identify these areas, you will be trading in line with the institutions and not against them. And then your chance for profiting will be much greater. Users of order blocks are large mutual funds, your retirement funds, hedge funds, bank and insurance companies, and then individual investors who've got multi-millions of dollars in their accounts. The institutions take very long-term positions once their decision is made. And this is why we analyze from the monthly chart all the way down to the smallest time frame for the entries. Because these institutions, like, they're holding these trades for a while. Like, as retail traders, guys, we don't have the power to create these big ass trends by ourselves, okay? We just don't. It takes huge amounts of money and positions to basically to make a trend happen. And that's why we're able to identify these order blocks before that move happens. All right. The participants of the participants who use order blocks manage hundreds to millions to tens of billions of dollars. And then this is why the daily and the 4-hour trends last so long. Because that transaction is going to gradually happen. At each consolidation or each pullback, they're adding more positions and things like that. Okay. Here's the advantages of using order blocks. Where they're able to be recognized after a consolidation or retracement, after then impulse wave. Okay. So basically, the longer or the steeper the consolidation after the impulse wave, that's going to increase your price volatility. That's going to give you the momentum that we want to see. All large-scale orders have an optimal average price target already predetermined, usually whole round numbers. Again, we're talking about institutions and businesses and things like that, guys, all right? They're not going to put an order in for, like, they're not going to use those the tiny little pips. They're nice round whole numbers. Creating too much volatility may cause price to trade away from the desired price or average price. And if that happens, that's usually when you'll see like a very steep, hard retracement back towards the low. All right, because it was too much volatility. So there's a exchange or a profit distribution real quick back into the same order block before it moves back into the opposite direction. Order blocks allow institutional traders to make the needed transactions in such a way that minimizes the impact on price volatility, but achieves a better average price. What to look for? Some common characteristics of high probability order block setups include you've got stops just above or below, depending on the trend, of a previous swing point. All right. You've got a consolidation. The longer the better, because the longer that it is, the more momentum is being compressed, quote unquote. Okay. You want to have a fib retracement in between the 618 and the 886 fib levels. I need to update that again. And then, of course, there has to be a swing point prior to the order block. The last candle, the last candle of prior trend move before the last candle prior, the last candle of the prior trend before the move is made is where the order block is. Shit, that's a tongue twister right there. And again, guys, I'm gonna show you this on the charts as well. Let's see. So let's look at the charts real quick. All right. I believe this is that markup we had from last class. And I said we were over here. Right? And I was telling you guys, I still saw the U-Chef short, right? But ideally, I wanted to see it retrace up into this zone right here, this red zone, which is, let's get that off real quick. Jesus, which is at the time, we would fib from this high to this low. And this zone would have been in between the 618 and the 886. That's why I highlighted it. Price never retraced up there. In fact, it had the 382 retracement. And from a previous lesson, I said the 382 typically has a strong, steep continuation, right? Look at this move off of that fib level. So it's just slightly below the 382, whatever you want to call it. But it's finding resistance below the 382. Previous lesson said that would have been a nice, strong, steep move down. That's a nice, strong, steep move down. And that's one reason why I said price was going to continue down. And then we checked out the daily chart, which also said price was going to continue down itself. Now let's clean this up a little bit. All right. So this green shade block is our order block, okay? Going back to the slideshow, characteristics of an order block. You've got your swing on a buy order, on a buy sell model, buy model. You got your swing low, your pullback that broke this previous structure high, right? Upon this pullback, you've got this A, B, then a C correction. From this pin bar right here and this low right here, let me move that. Notice where the lows are closing at. They're basically all relative to each other, especially right here. When you see this nice pin bars like this, that's exhaustion, right? Price doesn't want to go below this low. Price exhaustion. So even right here, this strong push right back into this order block and it shot out of there. So on this first shoot out is what we want to see. I mean, there's multiple opportunities for you to get in to go long right here, but this is what you want to see on the lower time frames. Something like this that breaks this structure and then leaves this low untested, because upon this A, B, C retracement, you're typically going to have a opportunity to buy within this order block. I told you guys last class that this was a buy model, but it was a bad trade to take. And I'll tell you why. This should probably, honestly, it should fade down just a little bit, but with this pin bar right here, again, we're looking at something like this. You come up and then slowly come back down to the retest and then pop up just a little bit. And now on this pop up though, it's going to test this high first. Now let's go to the 4-hour chart. So as we see on the 4-hour chart, we're closing below this order block. So what's going to happen is, if we're ultimately still in a downtrend from this high or from this consolidation, fib to the low, you've got your entries of the 618 in between the 886 just right here above this order block. Now around this order block is where you have a lot of people who have like pending orders, stop losses, and things like that. So there's voids of liquidity right here around this order block, especially right here. So what we want to see is price come up, test the bottom of this structure, get some equity, and then shift away. Because what's going to happen is it'll retrace a little bit. This price always retraces against the trend and then shoots back down to test this low. And it probably will break it. Let's see if I can show you all a good order block. Ooh. I believe we marked up, that's just crazy. So we marked up this pair last class as well, right? This is a perfect example. All right, so from this consolidation, you've got a wave 1, wave 2 that moves sideways, wave 3. Let's see. Now, depending on how the dollar collapses, we'll see this wave 5 be an extended wave 5, possibly. But right now we've got this rejection off a nice monthly key level, right? So as a current markup, right, it's a current order block that we're looking for. Let me go to the daily chart. That's a lot. Let's clean this up real quick. So what I'm going to do is mark from the tip of this wick down to the base of that candle, or the open of this bearish candle, right? Then this is on the daily chart. From the daily chart, go to the 4-hour. Remember, it's the last candle, depending on the trend. So on this uptrend, it's this last green candle before this push down. Go to the 1-hour. Last green candle before the push down. And again, order blocks form around our key levels. This order block is forming right at our monthly key level, right? To go even further, like I can go to the 15-minute chart and break it down some more. Last green candle. Before the move down. And I'm going to just keep right there. So now what we're looking for is we fib from this high to this low. And we're looking for price to basically retrace up into this zone. our order block is right up above this. So since our order block is right up above that, what we could see is a nice strong pin towards the high to reach into this order block, maybe even break the top of it just to reach into the liquidity pool before continuing down on the ABC correction of this wave 4 to test the top of this structure point right here and validate it now as a floor instead of being a ceiling. Which if we drag this order block over, right, that's something that we want to see. And then let's say if we fib from either this low to the high, just depends on which one you want to use. We can use that low or this low, either or, right? 618 to the 886. 618 to the 886. It's still around these order blocks. So that's what we actually want to see. Let's see. Do y'all have any questions so far? All right, we'll keep going. We'll keep going. Let's see. I need my phone plugged up. Damn. All right, so what I'm going to do now, guys, I'm going to mark up this chart for you guys. This is Euro AUD. All right, I'm going to do a quick markup of it, and then I'm going to show you how to find the order block and things like that. So again, start from the monthly chart using the horizontal line tool. Highlight your low to your high, and use nice round whole numbers. All right, so from this low, looking over here, I'm going to put that at, let's use this right here. So we'll just say $1.20. Well, actually, no, we'll use this low. We'll put it at $1.17 though. Boom. I like that. So on EA, we'll stick to the normal 1,000 pip range, or 10 cents. So we'll go from 117 to 127. And I'm looking for price again to see how it reacted around that price. Or looking at the candle bars to see how it reacted around the price. All right, so I'm gonna do a couple more zones real quick. Oops. So 127 to 137. I like it, I like it. And then I'll even do 147. Let's keep going. So I can move this one to 157. Boom. And then let me move this one to 67. All right. So you really want 3 zones, guys, right? So price is trading within these 3 zones. Until price breaks above this red line, these are only the 3 zones we'll work with. Until price breaks below, that's all we'll need. Once it does break below, we'll add another, 1,000 pip range. So now that we've got those 3 zones, we basically cut them in half, 500 pips. So for 157 to 162. And then again, this is your weekly mid-range or your halfway point. Let's see, 152. 42. All right. So as you see how price reacts around these areas, right? That's what we want to see. This is what we want to see. The structure of the market, price respecting these price areas. So from the monthly chart, once we've got that, delineated and things like that, we'll go down to the daily chart. Now, as we can see already, we've got this compression right here around this weekly mid-level. So I would say an order block is right here, right? Because again, what we want to see is shift in momentum, the retest that doesn't pass it, and then a nice break of structure for the retest to come down, and now it's going to shift away again. So on this bearish move, the last bearish candle is your order block. Highlight it from high to low with your rectangle tool, and look what happened. This pin bar over here reached right into that order block. If I fib from this low to the high, that's probably going to be somewhere around the 886. The closes of these candles, though, are going to be around the 786, I believe. Y'all see that? Closes of the candles right around the 786, which are where the pending order goes. The 886 gives you a more extreme opportunity to enter at a higher lot size because, again, your risk is just right here. The reward is all this. So, for instance, on this setup, if you was to take it, even just back to the high, right? Oh, man. That's still a 2.5, greater than a 2-to-1 risk to reward ratio. Any trade setup, guys, that you take, you always want it to be a minimum of 2-to-1. The reason this is because you can damn near be a 50% winning trader and still come out either net even, or profitable barely. Okay. The reason this is because for every, let's say your risk to reward is 2-to-1. So you're basically doubling up on your reward on your risk. So if you lose this one trade and you win the next trade, guess what? You won back what you lost from the previous trade and another one from this trade. Okay. So let's say you lose 2 trades in a row, but then you win one, right? Guess what? You just broke even because you're losing 1, but you're winning 2. All right. So that's a major key right there. Any trade setup you take, guys, you want to be sure it's at least a 2-to-1. If it's not worth your time or your effort, or it's not worth the risk at all. All right. Do y'all have any questions on how I found this order block? I'm going to show you all a major order block that hasn't been tested yet. So as we see this move down, right, before this whole move up as a whole, this last candle is an order block. So if we're looking for the bigger move, this is what we're looking at. So let's say price comes up here, right, and doesn't break this high. What you would do is, because there's an order block up here too, guys, right? Change of momentum, retest of this candle, failed, change. ABC correction. But if this is the fifth wave, let's see, one sideways, two, three. Okay. So let's just say if this is a wave 5, right? We'll see this price action come up, test the bottom of it again, which we could fib from low to high. I mean from high to low, and find our entries for the short for something that would look like this. Let's clean this up real quick. Boom. Okay. We'll see something like this as a bigger ABC correction. Now, whenever here's a nice general rule of thumb, guys. Whenever price rejects at one of these monthly key levels, its next target is the weekly. Now, if for some reason it doesn't reach the weekly immediately, or let me see. I mean, let's see. Well, I'm trying to find them somewhere where it didn't. Okay, so here's an example. So for instance, if you see price, closing above this weekly right here, this monthly right here, but it's still below this weekly level, it's going to come back down. And then once it starts closing up again below this monthly level, it's going to continue to that next monthly level. That's typically how price moves. Like, price doesn't move randomly. Like, once it enters a 1,000 block, it's going to complete or try to complete that 1,000 block in some degree. So going from this monthly mark to this monthly mark is 1,000 pips. This is a completed block. Now that it's a completed block, it's going to retrace, come up, like I said, possibly find some rejection again as it did over here. Order block it out for you guys. You gotta think where the money is at. Ooh. Order block it out for you guys. Down, low, down. Comes up to retest this high up here. We'll find, so basically what we're looking for is similar patterns, similar price exhaustion towards the high around this monthly key level to catch that short. Now, it may or may not get up there. What's going to determine that, though, is this low, this low. All right. Right, price gets above them. Well, shit. You see how price is already acting? Doesn't mean it's going to shoot down, though. See what I'm saying? So it'll be a nice retrace up. This is on the daily chart, by the way. So your momentum on the daily chart is already bullish. Let's see. So this is the sell model. This as a whole is the buy model. That's really all it is, guys. Let's see. Are there any questions so far? Let's see, I want to talk to you guys about risk management and proper journaling. All right. So before we continue on the charts, guys, an important topic, or a couple of important topics that I've been talking about as far as not trading is like psychology and journaling and risk management. All right. I don't know if you all have seen this or not, but I'm going to go over the risk management portion of trading. Basically, I always say, you know, you want a 2-to-1 risk to reward ratio, right? But how do you figure out and how do you calculate it? I'll tell you. I'll show you. Hold on. Blue sheet. All right. Risk management, like I said, guys, is going to keep you guys trading for a very long time, basically. So what we're going to cover is, you know, we're going to, you know, stress the importance of planning your trades and not just taking them. I'm going to show you how to calculate your risk to reward ratio if you're not following the compound plan. Okay. Because every trade, guys, is going to be just slightly different as far as how many pips your stop loss is and things like that. So you have to sometimes adjust accordingly to how wide it is. All right. Excuse me. Every trade has a different risk to reward ratio. So we must strategize every trade to determine the risk to reward or the reward to risk. We never want to really risk more than 2 to 5% of your account on any single trade. All right, as a new person, this is. And if you follow just that alone as a new person, that's not following the compound plan, you'll do excellent. Now, 2 to 5% doesn't sound like much. All right, it's honestly not much at all. But you got to understand, you're new to this. The safer you can be when you're new to this, the better. It'll prevent you from blowing your account. And once you get some experience under your belt, boost your percentage up, be a little bit more riskier, and that's how you become better with trading and things like that. Like, don't just put everything all on the line. We'll show you proper stop loss placement using a fib level hidden within previous structure, within usually a 30 pip range. Well, there's also going to be projected targets for take profit using your fib levels, key levels, previous structure, and then your price reversal zone. We've already covered that and things like that. All right, so the calculation of parameter indicates how much you are risking in comparison to the potential reward or profit. Okay. This calculation, well, basically, all this is going to sound like jumble for right now, but there's an example that shows you it's not really as much or as hard as you all think. Okay. So first thing you want to determine the amount of risk you want to place based on your account's equity, excluding any bonus. So let's say you got $1,000 in your account, right? You want to risk 3%. 3% of $1,000 is only 30 bucks. Okay. It's not much at all. I mean, hold on. 3% is, geez Louise, 300 bucks. So, I mean, and that's 300 bucks. And that's really not too much, but you know, it's a safe amount with $1,000 account. So check it. As a new trader, you only want to risk 2 to 5% of your account. So let's say you've got 10,000 in your account. Each potential loss should not exceed $200 to $500. So yeah, 3% of your $1,000 account is 30 bucks. $10,000 account, 3% would be 300 bucks. Okay, so let's use 1,000 for this example. Each potential loss should not exceed 20 to 50 bucks. If you're losing any more than 50 bucks on $1,000 account, you know, you're only going to be able to lose what, 20 trades in a row before you lose that account. You're not going to really lose that many in a row because hopefully, 2 or 3 in a row, maybe max. Other than that, you should be able to make more than what you're losing on these 2-to-1 setups. 1-to-1 reward to risk is acceptable, but like I said, it's almost a waste of your time. But anything over 1, X being the number over 1, is fantastic. So anything over a 2-to-1 is fantastic. Anything below is unacceptable, should not be traded at all. All right. If you have an account of $1,000, $30 would be your 3% risk or your drawdown, and then a good risk reward would be 1 to 3, basically risking 3% to gain 9. So you would risk 30 bucks to gain 120. That's great. That's what you want. Damn, I need to update this. With geez, that's a typo. With a $1,000 account, you're risking $30 to gain not 90, but it'd be 120. So say you want to have a valid setup requires a 30 pip stop loss. To work out what lot size is relevant, you would do the following. You take the $30, which is your 3% risk amount. You divide that by 30, which is your stop loss, right? And that's going to be $1 per pip. The risk amount in dollars divided by the stop loss size is the correct lot size to stick within the parameters. So what that means is the risk amount, which is $30, divided by the stop loss size, which is 30, okay? It's going to give you the correct lot size, which is $1 per pip. So that dollar per pip, though, it's not 1.00. It's going to be 0.10. Okay. Your account size, now here's a different view at it. Your account size, let's say, is $5,692. You want to risk only 2% at this time, as you are being more conservative. 2% risk of the 5,690 is $113.80. Now let's say you have a setup that you find that the required stop loss is 55 pips. What you do is you take the 113.80, which is the 2% risk amount, divide that by the 55 stop loss, and that's going to give you 2.06 per pip, or $2.06 per pip. That's not the lot size. You move the decimal place over. So this is going to be 0.20. You can possibly even do 0.21. All right. And what I'm gonna do, guys, is I'm gonna type up like a little cheat sheet for you guys. That gives you all this calculation and gives you all the steps that you need to take when you're entering the markets and doing technical analysis. Let's see. Stop loss placement. Your stop loss should be determined before any trade is really entered in accordance to your risk management rules. Stop loss is connected to risk directly, basically. The stop loss is there to protect you and your account. So, you really want to use it. I hate using them personally, guys. Keep it all real with you. I hate using them, but sometimes I don't even use them if I'm like that confident within the trade. But use them, guys. All right. Because at any given time, the market can become volatile, causing extreme price movements. I've seen it happen a few times actually. The best place to put a stop loss is hidden within previous market structure and with the fib level, if possible. The fib level I'm talking about is 1.1. And then once it's placed, you typically don't want to move it until price is well in profit, and then you'll have a trailing stop loss. All right. So this is the cheat sheet that I'm going to put together or print out for you guys, or give to you guys. Basically, it gives you each step, right? Polish your mouse. Step 1, identify your monthly levels, tells you what to do. Step 2, highlight any key levels with the rectangle tool. It's just basically all the steps that we've covered within the course so far, written out for you guys. So if you follow this step by step, every time you go to look for a trade, what do you do on step 1? What do you do in step 2? What do you do in step 3? What do you do in step 4? This is something that you guys will eventually, print out and stick above your trade station, or print out, put on your wall where you trade and things like that. So I'm gonna get this out to you guys. But the next thing I want to cover, guys, is journaling. I can't stress how important. I can't stress you guys how important journaling is. Actually, it's most important as a new trader or one who has struggled with consistency. It's important to the process of building a personalized trade plan, and then it's a key piece in the back testing phase, guys. Let's just think about this for a second. A lot of times folks will say back test a system, right? Back test a system. But in hindsight, if you back test a system, you'll find 100%, win ratios. You'll find all kind of winning trades. Okay, that's not accurate. What's accurate is the trades that you recorded that you took based off that system in real time. Okay, now that's going to determine your success by doing that in real time is going to determine the consistency or the efficiency of that system. All right. So that's why I say journaling, guys, is a key piece of your success to trading, because it's going to help you understand your personal trends. It's going to help you understand your psychology and your behavior. The more detailed, the better. Also, it's record keeping for tax purposes. It's a no-brainer. But again, just touching upon how this really helps you guys. Okay, let's say you'll once you all start journaling, guys, you'll notice all this shit about yourself. You'll notice what times of the day you trade better. You'll notice what pairs you trade better. Not only that, you will have a written down record of what happened in the previous trade session for a particular pair that you like to trade. So you can go back and see what happened on this particular day and why you took that trade. So now you've got a record of the market and the psychology behind that trade pair, an ongoing record. So it's a lot to journaling that people really overlook. All right. Now, your journal can be a physical or digital spreadsheet. Okay. Some things to include: you want to have the currency pair that you trade. You want to have what kind of position you took, the date you opened it, the time you opened it, time you closed it, the date you closed it. You want to have where you put your stop loss, where you put your take profit. Did you win or lose? And then you want to make a quick memo of how you felt at the time. Were you sad? Were you depressed? Did you have a lot on your mind? Things like that, okay? You want to include a before and after screenshot, and you want to include a list of confluence that told you to enter that trade. All right. Now, the reason why the list of confluence and a quick memo of how you felt, the reason why those two are on there is because with this list of confluence, you'll begin to recognize the patterns of setups that, or the list of confluence patterns that created the most success for you in your trades. So if you now know and are able to see this on paper, guess what, guys? In the future, more times than not, if that list of confluence or if that list of confluence, if that confluence isn't showing on the charts the same way as it happened before, you're not going to take that trade. And guess what? Chances are you're not going to lose. Okay. The reason why the quick memo of how you felt at the time is because, again, guys, this is a sport of psychology. It's like chess. All right. You can't just be out here trading. That's gambling. You can't just be entering the market just because you feel that the market's going to go a certain way. No. You got to take all your emotions away from it and enter off of technicals. Enter off of price itself, not based off how you feel, okay, but price itself. Like I said, because once you get your emotions tied into this, guys, like it's going to hurt you, man. Like you'll lose your account. If you're having a bad day, don't even trade, man. Don't even bother trading. If something's bothering you, if you feel out of whack, if you feel a little gloomy, don't even trade. Okay, because all those emotions, they're going to show on the charts. All right, they're going to distract you on the charts. They're going to cloud your judgment on a lot of stuff. Because when it comes to money, people tend to be more emotional in the first place. Nobody likes to lose their money. So that's why, whenever you're not feeling up to something, if you're not feeling good, if you're just blah for the day, don't trade. Because honestly, not even every day is a good trade day. You may or may not see a trade set up in the first place. And if that happens, you begin to, just trying to force a setup to be there that's not there. And that's something that you don't want to do in the first place. Not only that, you create your own trade plan, guys, that's tailored for you. Okay? What I'm giving you, what I'm teaching you is all shit that works for me personally. What works for me may not work for you. And this is why creating a journal helps you see if that system works for you. Okay. So when you're creating your trade plan, when you're reviewing your journal and things like that, ask yourself these questions and write the answers down. What currency pairs am I performing best with? Because you'll find most people, have a few favorite pairs. And guys, if you're just out here trading all these different pairs and you don't know how many you're losing on a certain pair and things like that, you don't know which pair you're performing the best with. So you're just out here just blindly trading. You got to have a game plan, guys, in this industry. Ask yourself what currency pairs do you keep losing with. During what time of the day are you finding you are most profitable? During during what periods of time has your losing streak started and finished? Which days are you most profitable? Which setups am I having the most success identifying? Am I most successful when I hold my trades for a long period of time, or am I a scalper? These are all things that you really need to figure out over time. These are all things that you need to ask yourself day in, day out. Because again, you're now tailoring a custom trade plan for yourself based off of your emotions, based off of your psychology and understanding of the markets, based off of your own personal goals. Once you answer those questions, guys, you should be able to build your personalized plan. Once you have identified the best of each question, it should enable you to become a more precise in your setups that you trade, increasing your consistency. Become picky in your trades, guys. Not every day will produce a setup to take, And then not every day should be traded. If no setup is present, don't force it. Once you become consistent, winning about 70, 60%, add a compounding plan to your trade plan, because then you're really going to see your money grow. And that's why I say, hey, compound. Let's see. These are just more, like I said, these are just more questions to add to your custom trade plan. Like, how many times will you check the market in a day? What currency pairs will you be trading? How many trades will you enter in at one time? What's the maximum risk on your account? What kind of trader are you? Are you a swing trader? Are you a scalper? Are you an intraday trader? What's your trading style going to be? Are you going to be just like straight technicals? You're going to be a mix of technicals and a fundamental. Define your stop loss, entry, and take profit of every trade, and compound your account. And we're finished with that part of it. Are there any questions? Let's see, stop this real quick. You guys got any questions? Hello, hello.
I'm good.
You good? All right, cool. MACD, RSI. There's like a few more things as far as, well, basically, the class is damn near done. All right, so next week, guys, all we're going to be doing is just like marking up charts and looking for setups for you guys to take. I am going to probably have a few of you all mark up a few charts in class if I'm able to. Like, I'll have you share the screen and then, do a chart markup or something like that. So that way, you can kind of be critiqued by me and just help you all identify some shit that you might be overlooking. You know what I mean? So we'll be doing that next week, and then we'll tie everything together some more. I'll introduce you to the MACD and the RSI, and then the triple screen entry method, because that triple screen entry method is basically like a system of checks and balances. It's a series of questions, and then that are just yes or no. And it's like if the MACD is saying this and the RSI is saying this, then it tells you basically, don't take a trade. But if the MACD is saying this and the RSI is saying this, then go this direction. That's basically what the triple screen traded entry method is. And we'll get to that next week. It's probably on, what's the first trade day? Monday? Yeah, so Monday. Trying to think. If y'all need me to show you anything on the charts, y'all have any questions? If not, guys, we'll call it done for tonight. We'll keep this one at an hour and then pick up on it on Monday. No questions? Oh, hold on. Oh, you're welcome, Michelle. All right now, guys. Well, let's get this recording out to everybody, and then I'll see you guys on Monday. Y'all have a safe day trading. Remember, it's Friday session, so don't expect too much movement after London tonight. All righty? Y'all take care.
You too, bro. Be safe, man.
All right now.